$1.2 trillion in a single quarter. Dealmakers are officially off the bench.
Just because boards are slapping AI onto every term sheet. It's pure FOMO.
Oh, come on. A third of that volume is real AI equity. You can't fake that kind of capital deployment.
Watch them try. But the wildest move isn't even AI. It's Intel dropping $14.2 billion to buy back its own Irish fab.
Classic Intel. Sell it, lease it, buy it back. We need to unpack why they are unwinding that trade right now. The rundown. $1.2 trillion in a single quarter. I almost dropped my coffee when I saw the league tables this morning.
It's a massive number. Q1 deal values are up 26% year over year. And if you read the analyst notes, they're spinning this whole pent-up demand narrative. Like every corporate development team just suddenly woke up from a 2-year nap.
Hey, as a recovering banker, I can tell you that nap was mostly just pacing around a conference room, waiting for interest rates to move. But balance sheets are healthy now. People are buying.
They're buying AI. That's the actual story here. Nearly a third of that total deal volume is AI-related equity investments. It's just tech companies hoarding compute and talent.
Fair, but it's not just tech mega deals. Look at the rundown today. Uber is buying Blacklane.
Which makes total strategic sense. Uber wants that high-margin chauffeur money. They already conquered the mass market. Now they want the guy flying private who needs an S-class waiting on the tarmac.
Exactly. Moving down the list, Lupin just officially closed on VISUfarma. GHO Capital gets a clean exit on their European eye care play. And Antin Infrastructure bought Sapphire Gas Solutions from Apollo.
Classic private equity handoffs. But the one I actually want to talk about is VISUfarma Partners. They just led a $1.7 billion significant risk transfer with Klarna.
Oh, come on. You're really going to make us talk about buy now, pay later risk transfers?
Yes, because the structure is brilliant. Klarna gets to offload a massive chunk of consumer credit risk while freeing up capital. It's synthetic securitization at its finest.
It's shuffling deck chairs on a consumer debt Titanic. You can't convince me that offloading Gen Z's sweater purchases to alternative asset managers is a sign of a healthy financial system.
You're just mad you didn't get the advisory fee on a $1.7 billion structured product.
Okay, guilty. But speaking of fees, the whisper numbers on Estee Lauder and Puig are getting loud, hearing they're deep in talks for a massive tie-up.
Predominantly stock-based from what I'm seeing, which tells me nobody wants to part with actual cash for luxury beauty right now.
I love a stock deal. It's basically two management teams saying, let's hold hands and jump. Oh, and GFL Environmental is quietly circling a major Texas waste operator.
Trash and makeup, the true twin pillars of the global economy. Quick note for tomorrow, keep an eye on Gilead. The clock is ticking on their extended tender offer for Arcelix.
Right, but speaking of massive piles of cash, we need to talk about what Intel is doing in Ireland. $14.2 billion to buy back their own fab joint venture.
The footnotes on that buyback are wild. We need to tear that structure apart. The big one.
$1.2 trillion, trillion with a T, in exactly 3 months.
Up 26% year over year. And nobody is waiting for perfect macroeconomic conditions anymore. The corporate development teams just got tired of sitting on their hands.
The pent-up demand is real. Bankers are actually sleeping at the office again. But you look at the breakdown and it is entirely skewed by the AI arms race.
Nearly a third of total deal volume. A third, just AI equity investments and mega deals. Which brings us to the $14.2 billion elephant in the room.
Intel, buying back the 49% stake in their Ireland fab joint venture.
For $14.2 billion. I read the press release 3 times to make sure I wasn't hallucinating the number.
Look, it makes sense. They needed the cash a couple of years ago to fund their foundry build-out. They did the JV. Now they want full control of the cash flows and the asset. It is classic balance sheet optimization.
Optimization? Nate, they are buying back their own factory. They already run the place. They already make the chips there. They just spent over $14 billion to change the name on the lease.
That is incredibly reductive.
Is it? Show me the synergies.
You do not need synergies for a buyback. In the AI era, owning your advanced manufacturing capacity outright is a strategic imperative. You cannot have a financial partner looking over your shoulder when you need to retool a fab overnight to handle next-generation packaging.
I agree on the strategic imperative part, but the price tag is absurd. They sold that stake when they were desperate for liquidity. Now they are buying it back when the market knows they are swimming in capital. The counterparty absolutely saw them coming.
Well, sure, if you sell your couch on Craigslist to pay rent and then try to buy it back 2 years later when you get a massive bonus, the guy's going to charge you double.
Exactly. And Intel just paid $14.2 billion for a used couch.
A used couch that prints advanced semiconductors. But fair point. It just shows the sheer scale of capital deployment right now. People are paying up for premium assets.
Speaking of paying up for premium, Uber is buying Blacklane.
I love that deal. Uber officially entering the white glove chauffeur business.
It is a fascinating margin play, but what really caught my eye this morning was the Klarna transaction. VISUfarma Partners just led a $1.7 billion significant risk transfer with them.
Buy now, pay later risk getting shifted off the balance sheet. The structuring on that must be an absolute nightmare.
I pulled the filings. It is a labyrinth of special purpose vehicles. I will explain the footnotes to you later so your banker brain doesn't short circuit.
Generous of you. But before we get to the Estée, Lauder, and Puig stock tie-up rumors, we need to talk about what is happening in the waste management space. GFL is quietly circling a massive Texas operator. Voices. I keep seeing this analyst note everywhere today. They are claiming companies aren't waiting for perfect macro conditions anymore. Q1 deal values are up 26% because of, quote, pent-up demand and healthy balance sheets, unquote.
Healthy balance sheets? I read that report and nearly choked on my coffee. They are citing Intel's $14.2 billion Ireland fab buyback as a sign of market health.
You don't think dropping $14 billion to buy back your own joint venture is a flex?
It is a massive defensive maneuver. They are buying back a 49% stake they probably never should have let go of. That is not pent-up demand. That is a very expensive cleanup operation.
Okay, fair. The Intel deal definitely skews the math. But look at the rest of the $1.2 trillion we saw in Q1. The other major talking point is that AI is fundamentally reshaping M&A. Nearly a third of total deal volume is AI-related equity investments. A third, Maya.
I am looking at the raw filings. Half of those quote-unquote AI deals are just traditional enterprise software plays, slapping a .ai domain on their pitch deck to get a multiple bump.
Oh, come on. You are being way too cynical.
I am being precise. If I buy a sandwich shop that uses an algorithm for inventory, is that an AI mega deal?
Look, if you pay a 50% premium for the sandwich shop, my former banking colleagues will absolutely code it as an AI transaction. You know how the game is played.
Exactly my point. The narrative is doing a lot of heavy lifting.
But the real money is moving outside of tech too. The loudest whisper on the street right now has Estée Lauder and Puig deep in talks for a massive, predominantly stock-based tie-up.
Pig? Wait, really? A stock deal there would be wild given their recent IPO.
Right? Just good old-fashioned luxury consolidation. And speaking of wild financial engineering, we need to talk about what VISUfarma Partners is doing with Klarna.
Because a $1.7 billion significant risk transfer is certainly one way to dress up a buy now, pay later book. Spill the tea?
The whispers out of Paris and New York are getting very loud about Estée Lauder and Puig.
I saw that. A massive tie-up. But the detail that actually caught my eye in the leak is the structure, predominantly stock-based.
Which makes total sense. You don't want to lever up a beauty conglomerate in this environment. You use the paper.
Oh, come on, Nate. You use the paper when your stock is actually a currency people want. Estée has been getting battered for quarters. Why on earth would the Puig family want to trade their shiny new equity for Estée stock right now?
Because they get a massive premium, Maya, and a seat at the adult table. They went public, 2 years ago? They're still a family business wearing a trench coat pretending to be a global giant. Estée gives them distribution they could never build on their own.
I'll believe it when the S4 drops. I just think the Puig family values control way too much to take paper from a struggling legacy brand.
Fair enough. Well, if high-end perfume isn't your thing, how about literal garbage?
Always my favorite sector.
GFL Environmental is quietly circling the wagons in Texas. Hearing they're very close to scooping up a major independent waste operator down there?
That fits the first quarter data perfectly. Analysts just pointed out deal values are up 26% year over year. And it isn't just that trillion-dollar AI boom inflating the numbers. It's these gritty, cash flow positive roll-ups. Buyers are finally tired of waiting for perfect macro conditions. They've got healthy balance sheets and pent-up demand.
Trash never sleeps. Recession, boom, AI taking our jobs. Humans will always make garbage, and someone will always want to consolidate the trucks. It's the perfect business model.
It really is a beautiful ecosystem. Speaking of clocks ticking down, we should probably look at Gilead before their tender offer expires tomorrow.
Oh, right, the ArcLX situation. Tomorrow's radar. I'm telling you, Estee Lauder and Puig are way further along than people think. My guys are saying it's going to be a massive, mostly stock tie-up.
Mostly stock? Oh, come on. Estee Lauder is going to use their battered paper for a transformational deal right now. I need to see the exchange ratio before I buy that narrative.
You can't look at this like it's 2023 anymore. Companies are done waiting for perfect macro conditions. Q1 deal values are up 26% year over year. Everyone has FOMO.
Sure, but a third of that volume is just people slapping the letters A and I on a pitch deck to justify a premium.
I feel attacked.
You should. Anyway, tomorrow morning, watch Gilead. The clock is finally ticking on that newly extended tender offer expiration for RCLX.
Right, and White Mountains Partners should be dropping their official closing announcements for Base 6.
Assuming they don't find something ugly buried in the final audit.
Always the optimist. We'll see whose radar is right tomorrow.